Hi, I'm Lauren Mason, and I'm joined today by Carl Stick, manager of the elite rated Rathbone Income Fund. Thank you for joining me today.
Absolute pleasure to be here, Lauren. Thank you.
Rathbone Income has one of the best dividend payment track records, if not the best dividend track payment record within the open-ended fund space, having increased its dividend payments during 23 of the last 24 years. What's your secret?
I think there are a number of factors here. The first one is actually quite simple. It's understanding that our clients want to have a pay rise every year. That is why they buy an equity income fund. So that's always been a focal point for us. And then using that as a starting point, when we look at individual businesses, we are always trying to understand whether or not that business is generating enough cash through its earnings, generating enough earnings growth through its business, and thereby producing dividend growth on a yearly basis. And if we can accumulate that across the portfolio, we raise our dividend by a real amount every year. That gives our unit holders a real pay increase every year.
And last year, dividend cover was reportedly a bit stretched, and this was predominantly among some of the largest UK companies. Should income investors be concerned? What are your thoughts on this?
It's a headline, but I mean, you've actually touched on the principal point there, that figure, that dividend cover figure, is dominated by these very big industries, these very big companies. So we have to be quite circumspect in how we invest in those areas. I think sectors like the oil sector, where dividend cover is low, we're seeing an improvement there. It's quite low in the pharmaceutical sector. We're sort of half and half with regard to our view there. And in other areas like telecommunications, you've got to question whether or not those businesses should be paying out the dividends. So on the large cap arena, yes, that's very clearly an issue. But we look beyond that, whether it's in the smaller businesses within the FTSE 100 or going down into the FTSE 250 and the small caps. There you are seeing more substantial levels of dividend cover, and also, in many cases, greater opportunity for dividend growth. So it's not just the big companies that dominate the headlines, it's looking below those.
Okay, so in light of that, which sectors and areas of the market are you seeing the best dividend opportunities in at the moment?
I think the best way of answering that is to focus on three specific areas, and I've touched on two of those. The oil sector, I think, is interesting. Companies like BP and Shell have a stated aim to focus on what money they're spending on capital investment, and they're trying to reduce that and be more savvy, more clever in what they do. That is improving cash flow, and that is supporting their dividend. And importantly, as the oil price has risen over the last 12 months, and the oil price is very volatile, but as it has risen, it's adding extra support to that dividend cover. So we may not only get high dividend yields from that sector, but also dividend growth. So that's a tick in the box. So I think that's a good area for investors. Another large area are the pharmaceutical companies. Here, as I say, it's a little bit more nuanced. I think AstraZeneca is interesting, decent yield, but you're relying on a pipeline coming through, so there's greater risk there. But a business like GlaxoSmithKline, where we are not expecting dividend growth, I wonder whether or not the market's getting a little bit too jaundiced in its view about Glaxo, and actually there's some good things happening which may eventually come through into dividend growth. So those are two big sectors, pharmaceuticals and oil, but I think the really interesting area might be more value oriented. Why don't we look at the UK again? Investors globally don't like the UK. We've had lots of issues specifically around Brexit and the impact that might have on our economy. But there are a lot of good businesses in the UK that are very lowly rated. The shares are cheap, and that affords us a decent level of dividend yield. And then if you can get growth coming through on the back of that, you're getting a value business, a decent business potentially at a decent price, and yield and dividend growth. And I would suggest that people maybe look at areas within the leisure sector, look at areas within specialist retail, not general retail, but a business like a Halfords. Businesses like Green King and Restaurant Group have seen rebounds so far this year because people are suddenly realising, you know what, things aren't quite so bad, or maybe things are going to improve at some point in the future. So that's a different area, that's a contrast to your oils, and it's a contrast to your pharmaceuticals.
Carl, thank you very much for coming in today.
You're welcome. Thank you, Laura.
Thank you.